Assalamualaikum and hello everyone. Welcome back. This is the chapter 2 on the 2018 Conceptual Framework for Financial Reporting, and chapter 2 deals with qualitative characteristic of useful financial information. What are qualitative characteristics of useful financial information? What are the qualities that financial information should have possessed? According to the conceptual framework, the types of information that are likely to be most useful to the existing and potential investors and other creditors, which is to help them in making decisions on the basis of the financial information provided in the financial statements about the reporting entity. And that includes some explanatory material about management expectation. It may also include strategies for the reporting entities and other types of forward-looking information. These are some of the useful financial information. But what are the qualitative characteristics of those useful financial information? Conceptual framework divide those useful information into fundamental qualitative characteristic, the quality that is the key characteristic that financial statement should have possessed, which are relevance and the faithful representation. On top of that, apart from having the key characteristic, which is the crucial characteristic that financial information should have possessed, relevance and faithful representation, the financial statement should also have the so-called the enhancing qualitative characteristic, which is the characteristic that will improve further the key characteristic or the fundamental qualitative characteristic which are necessary. What are relevance? And we're going to look into that, but before that, relevance has its three ingredients, which is the predictive value, confirmatory value, and materiality. Whereas faithful representation, the ingredients to have faithful representation is to have completeness of information, free from error, and also the information must be as a result of an action which is just neutral, or in other words, neutrality. What is the enhancing or the qualitative characteristic here is those that improve further the fundamental qualitative characteristic, EQC. There are four qualitative characteristics which are considered as enhancing qualitative characteristic. The first one is comparability, the second one is verifiability, the third one is timeliness, and the last one is understandability. Let us now focus and look at the fundamental qualitative characteristics of useful financial information. Under the conceptual framework, the fundamental characteristics are the necessary or the key characteristic for financial information to be useful to the decision making made by the existing and potential investor, lender, and other creditors. And those key characteristic is divided into two. One is relevance. The other one is the faithful representation. Let's look at the first one, which is relevance. And these are very important in terms of the vital characteristic that financial statement should have striven to achieve. The fundamental qualitative characteristic of relevance. What do we mean by relevant? When does the information is considered as relevant? Information is considered relevant is depending on how that information is capable of making a difference and influence in the decision made by the users. Decision made by the users we have discussed in our previous video, which is decision made by these three primary users. Even if some of those users choose not to take advantage, or they are already aware of it from some other sources, providing that information is still considered relevant if The information is considered as relevant here is those that are in the general purpose financial report. They are deemed relevant if the information possesses these ingredients. The first one is predictive value. We'll be going into that very shortly. The second one is that information must have confirmatory value or both. Either predictive value or confirmatory value or both. And not to forget, the most important thing is that the information under relevance must also be the information that possess materiality. Let's look into the details of relevance. As I mentioned, information is considered relevant under the conceptual framework if the information is capable of making a difference. Making a difference of what? In the decision made by the users, if the information possesses these ingredients that will be illustrated. The first one is predictive value. What is predictive value? Information is said to have a predictive value if that information can be used as an input to processes employed by the users to predict future outcome. For example, you can use the information regarding the sales of the company to be able to predict the future sales of the company. Use the existing or the current year sales to be able to predict the future financial performance of the company. And having predictive value does not mean that the information need to be a prediction or a forecast to be able to have that predictive value. Potential investors, for example, if they are interested in purchasing shares from the company, so information regarding dividend payment might also be a relevant information because the past dividend payment may also give some indicator of what would be the future dividend payment of the company. The second characteristic or the second ingredients of relevance is confirmatory value. Confirmatory value is related to the information that can provide feedback about or just confirm or those changes of the previous evaluation. For example, let's say we have a financial statement that are being issued at the year end, and those financial statements that are being issued at the year end or as at the reporting date has confirmed or changes the past expectation based on the prior evaluation, the previous evaluation based on the financial statement of the previous period. So therefore, that gives a confirmatory value because it confirms or sometimes changes the evaluation. Let's say the information relating sales. If in the financial statement, the actual amount of sale is 1 million. And based on your prediction, you predict it is 1.2 million. So that information of 1 million will be able to confirm your previous evaluation on the sales that was 1.2 million. So that there are the changes could have been made to the future evaluation. The next one, and these things, before I go to the next ingredient, they are actually interrelated. So you should have this either predictive value or confirmatory value or both. And these are interrelated, predictions and confirmation of predictions. The next ingredient is materiality. Materiality is about information which is considered material. So when we talk about predictive value and confirmatory value, that information is considered material if the omitting or the omission or misstatement of that information could influence decision users make on the basis of the financial information about that reporting entity. For example, there is no clear-cut measurement regarding materiality, but it is an entity-specific aspect of relevance based on the nature or magnitude or both of the items to which the information that are of concern that contained in the entity's financial report. So there is no uniform or quantitative threshold measurement of materiality that was actually specifically mentioned in the conceptual framework. Next, we will be going to the next part, which is on the next fundamental qualitative characteristic, which is the characteristic of faithful representation. Faithful representation is the second fundamental quality that makes information in the financial report useful for decision making. And faithful representation means the information or the financial information in the financial report should faithfully represent the substance of the economic phenomena. Economic phenomena, let's say, is about the profit of the company. So in words and also in numbers. Or maybe just about the asset of the company relating to inventories. So it should be correctly represented, that it purports to represent. If the substance of an economic phenomenon and its legal form are not the same, providing information only about the legal form would not faithfully represent the economic phenomenon. So it's important for us to consider substance over form, because if that is the same, not by providing legal form, that might not be faithfully representation of financial information. And faithful representation relate to the following ingredients. Information is faithfully represented if it has the following ingredient. The first one is completeness. Completeness means that all information should be that are necessary for a user to understand the economic phenomenon being depicted must be included in the financial report. So the information that is complete, for example, if you have a carrying value or carrying amount of an item of property, plant and equipment, to make it complete is to have the notes to the account, which shows the movement of what are the balance at the beginning of the year and what caused the balance to be the one that was shown in the statement of financial position. So providing necessary description, explanation, and processes to arrive at that numerical information, the numbers, and also giving some significant facts about the quality and nature is considered as complete. For example, if you provide information on PPE or maybe on receivable, so the details of what make up the receivables of your company are considered as providing complete information. The next one is neutrality. In simple word, neutrality means company cannot simply select or just try to provide information which are in favor of one set of interested parties over another. So information shouldn't be biased. So there is no bias in the selection or presentation of financial information in the financial report, so that the users should be free to make their own judgment and economic decision. The information also shouldn't be slanted, weighted, overemphasized, or maybe de-emphasized, and also being manipulated just for the sake of increasing the probability that the financial information will be received favorably or unfavorably by users. If you have information regarding the lawsuit that the company have been filed for, that disclosure that is regarding the lawsuit, if that is going to be disclosed, will actually be also being neutral to be disclosed, even if that would be at the damaging side of the company. The next one is that to consider neutrality here is that it must be free from bias, or to the end, if this is with bias, we will no longer have credible financial reports. Free from error. The information is said to be free from error, or where there is no errors or omission in the description of the economic phenomenon. And also there is also no error in the process to produce the reported financial information. Whatever selection of models, whatever selection of estimation of whatever percentage or whatever amount should have been done with no errors. It does not mean that it should be perfectly accurate in all aspects. The most important thing that the information are free from errors if they are not misleading and they faithfully represent the financial result. If you have an information on loan, the loan is not misstated. For example, there are no misstatement. If the loan is actually 300,000, for example, the financial statement shows, let's say 200,000. That is with error, and therefore there is some misstatement, and that would result in a fraud if the information are not free from error. Next one is the enhancing qualitative characteristic. As I mentioned, the conceptual framework refers this characteristic, the EQC or enhancing characteristic, to be the characteristic that will improve the usefulness of that information containing in the financial report, that is both relevant and provides also faithful representation. The most important thing is to strive for the fundamental qualitative characteristics of relevant and faithful representation. These are the main actor. These are the actor in a leading role, relevant and faithful representation. Whereas enhancing qualitative characteristic could be regarded as actors in a supporting role. So they are still important because that will improve further the financial statement that is trying to represent the useful financial information. The enhancing qualitative characteristics are comparability. We'll be looking into that. Verifiability, there are 4 of them. Timeliness and understandability. Let's look into detail. Enhancing qualitative characteristic of comparability simply means that the information, let's say, is the profitability of your company. Let's say that is the information, your profit for the year. You can compare similar information about other entities. You can compare your profit with another company's profit within the same industry, with similar entities that has the similar information about the same entity as well. So you can also compare not only information about different entities with the same information, or you can also compare that profitability of this year as compared to profitability of last year or the last few years. That is also comparability when you compare the same item within different period or another date. Alternatively, what is more important is that consistency is the key criteria for comparability. Consistency is the one that helps to achieve the goal. The goal here is the comparability. So it means that information that is measured by different, maybe in a similar manner for different companies, and also the information which you compare for the same companies in different years, which we call trend comparison. The next one is verifiability. Verifiability is the information that helps the users. The information should be able to help the users or to assure the users that information that are provided are faithfully representing what it purports to. This means that different knowledgeable and independent observer could reach consensus, although not necessarily complete agreement. For example, you have two independent auditors that make a physical count of your inventory. The verification of an amount for the asset, the inventory, can occur by simply counting the inventory, but they still arrive at the same physical quantity amount of that inventory. So it means that they can still reach consensus, although not necessarily complete agreement. The next one is timeliness. Timeliness simply means just in time, having information available to decision makers just in time to be able or to be capable of influencing their decision. Information should be made available on timely basis, meaning that the sooner the information, the better it will enhance the capacity to influence decision. And if that is provided late, or a lack of timeliness can somehow uh, uh, impact the usefulness of that information. So the older the information, the less useful it is. The next one is understandability. Decision makers, like the one that were made by the investor or the potential investor, is based on the financial information. And our assumption is that, according to the conceptual framework, it can be read and understood by the users. Users, according to the conceptual framework, are also assumed to have reasonable knowledge about the business, about some accounting background, and how to make them understandable is by classifying, characterizing, and presenting information as clearly and as concisely as possible. That will make it understandability. That will make it understandable, and the understandability characteristic will be able to achieve. So basically, the quality of information that will let reasonable informed users see its significance. So information here does not simply mean that complex information or difficult information should be excluded. So users should take their own initiative by trying to review and analyze the information with reasonable diligence. How do we apply those enhancing characteristics, qualitative characteristics? We should try to maximize to the extent possible. So what happens is that the process does not follow any prescribed order. Sometimes one EQC or the enhancing qualitative characteristic may have to be diminished to maximize another enhancing qualitative characteristic. However, what is more importantly is the two fundamental FQC, which is relevance and faithful representation. So you can look at the example of the adoption of MFRS 15 in the early years, where at that time there would be maybe some temporary reduction in comparability of the sales information that were during the period of MFRS 15, the post period versus the pre period. However, that is still worthwhile because it will later improve relevance, which is the fundamental qualitative characteristic, and faithful representation of the revenue information in the longer term. Providing useful information are not free, and any information, there will be a cost that will have to be incurred either to the information provider or to the receiver or the users of the financial information. So reporting financial information will impose costs, and cost is a pervasive constraint on information provided by financial reports or in the financial statement. What is more important is that the benefits that are derived from providing that financial information should exceed the cost of providing it. Because why? That is the reason, because different individual assessment of the costs and benefits of reporting particular item will vary. Let us look at the costs incurred, some of the example of the costs incurred to illustrate the cost constraint on useful financial reporting. Costs incurred by providers and users of information. The providers are normally the reporting entity, which is the company or the entity that prepares the financial report. And the cost that will incurred by them would be the cost of collecting, the information processing, verifying it, maybe having the internal and external auditor to verify the information, and disseminating that information to the users of financial reports. Next is looking at the user's perspective. For users like potential existing investor, lenders, and other creditors, they will have to also incur costs. That is the cost of trying to understand, how to understand, trying to analyze, interpret, and also obtaining additional information to enhance their understanding of that financial information provided. That's it. That is so cool. You are done with chapter 2. Now we'll go to chapter 3. So just click the next chapter whenever you are done with it. Thank you so much for watching. I'll see you when I will see you. Assalamualaikum and bye-bye.